Hey, what's up, everyone? My name is Ali. Welcome back to my world of stocks. Man, has it been a crazy week? Really, these past couple days have been some of the worst in the stock market, like ever, in terms of like a point drop in the market. But especially in recent history, and we're just seeing stocks across the board getting hammered, and some are really cratering. Now, in today's video, I want to talk to you about what some of my favorite stocks will be to buy this year. Stocks that I'll be looking to buy. Maybe I'm already buying, maybe they're high up on my watch list, but these are some of my favorite that I'm hoping just continue to fall in price. Now, a couple of things to get out of the way first. I'm going to be I'm going to be trying to do a video, like a deep dive on this entire situation soon, where I'll share all of my opinions on everything going on with tariffs, what I think is going to happen to the economy, with the stock market, with the country, all that kind of stuff. I'll try to share some thoughts on all of that in a separate kind of deep dive video. But in today's video, we're more so looking at this as like what kind of situation are we in it? Because in my opinion, I think we're going to have an extremely volatile year. Things might get worse before they get better, probably will, because we haven't even really seen what the impact is going to be yet from all of these tariffs. And maybe there will be times where trade deals get announced with certain countries, and maybe that shoots stocks up a lot, maybe it kind of surprises people. But likely there will be situations where economic data comes in and we start to feel the impact from all the tariffs and stocks just continue to fall. It's also highly possible that we go into a recession, could have a full on market crash. The point is that it's going to be a period of extreme fear and extreme volatility, in my opinion. And look, as a long term investor, I could panic and never touch any stocks during this period, or I could go in and buy stocks the more that they fall and pick up some great deals for the long term. And that's what I always do. I've done this. You can look back at my videos on YouTube. Other time periods where the market fell and cratered, periods like 2015, 2016, 2018, there was a drop there. 2020, there was of course, pandemic crash. Even after the pandemic, there was like a pandemic recovery, and then what I call a post-pandemic crash. And during all those time periods, I put out tons of videos saying that I was going to be doing like the majority of my buying as stocks got lower in price. And lots of people would leave comments saying, you're dumb, like things are just going to get worse. Why would you ever buy now? And that tends to be the kind of sentiment from most people in the market, in my opinion. And they kind of end up with analysis paralysis, where they just always think things are going to get worse, and then they end up never buying anything. And I'm just not that type of investor. I'm a long-term optimistic investor. So when I see prices falling, those are my favorite times to go in and hunt for the best deals. And the more that they fall, the more I'm going to be buying of those. And then long term, I end up with some great, low cost bases on some of my favorite stocks. And then people leave comments saying like, how did you get such a low cost basis? Well, it's because during time periods where everyone was panicking and prices just continued to fall and nobody wanted to buy in and everyone was just exiting the market, I was going in and I was taking those stocks off their hands and I was buying them at those lower and lower prices. So that's what I'll be looking to do this year. Now, the main thing I want to get across too is that I really want to be buying some market leaders, some of the best companies that I just feel like they really wouldn't get dragged down just because of their own fault, but rather something bigger happening in the macro environment that drags those stocks lower. And thus, it's really one of the best buying opportunities for those specific stocks. Now, that's not to say that in today's video, I'll be covering every stock that I'll be buying this year. But if you were to ask me like, Ali, what are the stocks that you're going to put the most amount of your money in this year? Like, what are the stocks that you're going to buy the heaviest, the more that they fall? And especially, if we have like a market correction, market crash, a recession, like where are you really going to be putting the majority of your money in stocks? These are the ones that I'll be buying. And I'm going to show you today how they're already crashing. I'm going to show you how much they're falling already, and potentially could continue to fall. And that's why I'll be buying them. Okay, I think I covered the basics there. Now I'm going to separate these stocks into kind of three categories. We'll first cover some core foundational stocks that I think are just amazing, as like dominant companies, and yet their prices are falling. Those will be like some of my favorite. Then we're going to cover some riskier stocks that I still really like, but I think they're going to be hit a bit harder from tariffs. And I'll be looking to get those, as low as possible. And then at the end, I'm going to finish with some dividend stocks, which are some of my favorite to buy during market downturns like this, because when prices go down, yields go up. and I can't wait to share them with you. So let's not waste any more time. Let's just go ahead and jump into it. I'm just going to kind of go, it's going to be a little bit of like a live situation where I'll just be clicking through stocks here and showing you the prices in real time. I'm recording this on Friday, and I'll be showing you the prices in real time, how they're falling already, and why, I'll be looking to buy them. Okay, so starting with the core stocks first. As you can see, I've got a few here: Google, Amazon, Microsoft, Meta, just amazing companies, so profitable, so dominant. Some of the, doing hundreds of billions of dollars in sales, still growing at double digits somehow. And the first of them is going to be Google. It's probably my favorite overall stock in the entire market right now when you just look at everything they do and the valuation. But look, I'll just show you really quick. The valuation, you're talking about a PEG ratio that is actually like 15% cheaper than the sector already. And yet you're looking at the stock here, it's down about 12% in the past week alone. And you look at like the past, 3 months, it's lost over a quarter of its value. Now, this is normally a very strong performing stock, but now you're seeing it fall here. And I'm just hoping that it continues to crash so that I can buy more. And yeah, this is a company that maybe is not going to be hit too directly by tariffs, but if the economy tanks a bit and you see advertising rates fall, that can trickle down and actually hurt Google stock. So that's why you're seeing it fall here, and hopefully that continues. And yeah, I'm already buying some Google, but I'll be looking to buy a lot more if it continues to fall. Now, Amazon, another company, I just love this one because they're so dominant, have so much infrastructure. They're so hard to replicate in terms of all their e-commerce, number one in cloud. And yet, the stock is falling about 15% this past week. You look at like the past 3 months, it's lost about a quarter of its value. I've been wanting a dip on Amazon. I've been waiting for one. We're finally getting it. It's still not quite as much as we've seen in the past, but if it continues to fall, man, this could get very, very attractive very soon, because even already PEG ratio is about the same as the sector. So it's already, a decent price, but the more it falls, the more attractive it gets. Hopefully this downturn continues here for Amazon. Now looking at Microsoft. Microsoft, a little bit higher valued in my opinion, but has always been one of my favorite stocks. Down 7% this past week. I've been waiting for it to take a bigger hit. It's down about 16% the past 3 months. You look at a 10-year chart, always such a good performer. It's kind of just now starting to come down a little bit. Maybe if we use a 5-year, we could see it a little better. But yeah, I would like it to come down a little more, but it's kind of starting to fall now. And yeah, it's going to start to get more attractive here. Now, Meta, I've been waiting for a dip on Meta. Finally, we're getting it. The past week, down 16%. I mean, such a dominant social media company. You look at like the past month, lost 20% of its value, a fifth of its value in the past month. And you look at a 10-year chart, such a good performer. And recently, it had really skyrocketed in price. So now we're finally getting this downturn here. And I just really want that to continue. The further it goes down here, starts to get down to these levels, oh yeah, I'll definitely be looking to buy more Meta stock. Okay, so those were kind of the core stocks. Let's increase the risk a little bit. These are some stocks here that I really like these ones, but I think that the tariffs and just the economy tanking could hit them a bit harder, a little higher valued, some of them. Let me just show you. We'll just run through them. So starting first here with Palantir, we've got Palantir. Now, Palantir may not, directly be impacted by tariffs, but the economy tanking, businesses maybe not hiring Palantir as much, which I think would be crazy because, excuse me, Palantir actually helps a lot of companies run more efficiently, which would be crucial during an economic downturn, but I could understand why the stock is still falling. It had already climbed by a lot, so to fall now, it's down 18% in the past week. I love Palantir stock, but I've been waiting for it to fall because it had actually climbed a lot. In fact, it's about flat year to date still. And if you look at if we zoom out, this is probably more accurate here, a 5-year chart, you can see that it had really skyrocketed recently. So now it's finally coming down here. It's finally coming down. It was, I think at one point it was like over $120 a share or something. Now it's in the 70s. If it comes down to like the 60s, the 50s, the 40s, oh man, that really starts to get attractive for a stock like Palantir. It's a highly valued one, but so much future potential. If we can get past, this downturn in the economy and this kind of trade war that we're building here, could be a high flyer once again in the future. Now, NVIDIA and AMD, two chip stocks that have been crushed lately because, of course, they have a lot of business in China. They will be heavily hit directly by tariffs, but These are companies that I think have very bright futures for them. Now, I do not own AMD. I do own Nvidia. And in the past week, it's fallen 15%. Guys, Nvidia was already looking pretty attractive because PEG ratio, it's actually like 50% cheaper than the sector. Now, that's assuming that their EPS like soars as analysts expect, which is, might not happen with tariffs. So, but the point is, if we kind of get past the tariff situation in the future, those UPS could recover. And then you're talking about like a stock that already had a cheap valuation, but it's fallen 15% this past week, 16% past month. You're talking about almost a 40% crash in the past 3 months. And when you kind of zoom out a bit here, yeah, you can see that it's finally starting to come down here. Now, it is still up over 1,000% in the past 5 years because it's skyrocketed recently, but this is a very popular stock that everybody has been wanting to own, but everybody said it was too expensive. Now you're finally getting it to drop. If it continues to drop like this, yeah, Nvidia starts looking a lot more attractive. Now, AMD, kind of a budget alternative to Nvidia and Intel in terms of their products, but man, I don't own it, but it has been getting crushed. It's getting very interesting. It's down about 20% in the past week. You're talking about 33% crash in the past 3 months. But really, if you kind of zoom out a bit, you can see that this used to trade for over $200. Now it's in the 80s. So it's lost over half of its value, and it's really starting to come down here. So if this continues here, hopefully this continues. Hopefully we get down to these levels. I mean, man, if it goes down to like the $50 range, like we saw like in 2022, that would be extremely attractive. I might have to buy in. If AMD goes down to the 50s, I might start buying AMD myself. SoFi, another stock here that I really like. I own SoFi, and it's just such a great fintech. It's doing a great job, really kind of disrupting a lot of the financial kind of markets. It's great for investing. It's great for doing all your finances in one place. And in the past week, it's gotten crushed 20%. Obviously, if the economy tanks, a stock like this could really get hit hard, but it's already getting hit hard. And you look at like the past month, it's lost a quarter of its value. Past 3 months, down almost 40%. And really, you zoom out a bit, look, we could look at all time. It's negative all time. So I'm assuming it's actually down from its IPO price. And I mean, if you're telling me that I can get SoFi stock for a cheaper price than where it IPO'd at, I mean, that's extremely attractive to me because I think SoFi has done a great job since IPOing. They've grown a lot, they've gotten a lot better, and yet the price is lower. So that's already very attractive to me. And if it continues to fall like this, I mean, we get down back into the $6 range like it was, not too long ago. If it gets down to like the $6 range, that would be massive buying opportunity. Look, it used to trade for like $4. I think at one point it was like even $3. So yeah, SoFi could get extremely attractive the more it keeps falling here. Okay, so those were just like a few kind of riskier plays there. But what I'm extremely interested in are some dividend stocks. So let me just share with you some of my favorite dividend stocks that I'm keeping a very close eye on right now that I can't wait to scoop up if they keep falling and those yields keep rising. Okay, so first up, there's a couple of REITs that I really like, and those are Vici and EXR. These, I think, are not going to really get hit directly by tariffs because, like, for example, Vici owns a bunch of resorts and casinos. EXR owns, like, storage facilities. Not really something you would tariff, but the kind of fear is that if the economy tanks, then, maybe people start spending a little less at these casinos, resorts. Maybe it hurts their rents. Although I will say Vici still collected all their rent during 2020 when things were getting locked down completely. So I actually think that they're very resilient. And yet the stock is falling a little bit now. I was hoping for a bigger drop. We might have to wait for some of these because I think a lot of investors are seeing these stocks as already very attractive. So they're kind of buying them even right now, and that's preventing them from crashing like we're seeing so many other stocks cratering. But the more that they fall here, the more attractive they'll get. Vici is down 4% this past week. But year to date, it's actually positive. And if we kind of zoom out a bit, we can see that it has been suppressed in recent years, but we really just want this downturn here, this dip. We want that to continue. If it can get down lower, it would really start to get much more attractive. I mean, shoot, during the pandemic, guys, it was like it was in the teens. I mean, it was so dirt cheap. And you look at the dividend yield, it's already yielding over 5.5%. So we really just want Vici to continue to fall and be able to buy a lot more. I want to I want to go ham on Vici. I also want to go ham on EXR because EXR is another great one. I love this REIT. It's down about 5% this past week. Year to date, only slightly negative. But what we can see is that since the kind of pandemic highs, it is down quite a bit. So it has been kind of falling for a little while. We just want this dip to continue here, get even lower, and get that dividend rising. The dividend right now is 4.6%. If we get that dividend up to like over 5%, yeah, it starts to get really attractive. Over 6%, we're talking about mouth watering. So yeah, that's another one. Vanguard High Dividend Yield ETF. This is the only ETF that I own in my portfolio. And it's just because it has a lot of good dividends in it, a lot of good dividend stocks, and it's just the only one I've ever owned. However, it always performs extremely well. Like if we look at a 10-year chart, it's always performing very well. So I was waiting for a dip. We're finally getting a dip in this one too. This past week, it's down 9%. So we just want this dip to continue here. If we can get that a little lower and get that dividend rising, because right now the dividend, where's the dividend at? The dividend is it's about 3%. I think it's actually higher than that because this is delayed. But yeah, so we want to get that dividend. We could get that dividend up to like 4%, maybe even 5%. I mean, we're talking about, yeah, some really good dividends there. Medtronic, one of my absolute favorite stocks just in general, but they will absolutely get hammered by tariffs because they're basically the world's biggest provider of medical devices. So yeah, that's going to be impacted by tariffs. But thankfully, the stock is kind of dipping a little bit. They were doing pretty well recently, so I don't think it's down a whole lot. Like past month, down 13%. However, when everyone was really crazy about healthcare stocks, like during the pandemic, this was a high flyer. It was up over 130. Now it's fallen, it's come all the way down here, and now we're seeing this dip here at the very end. So we want this dip to continue. If we get it down to like these levels, like 70, if we get it down to the 60s, that would be extremely attractive for Medtronic, who already yields over 3%, but we want like 4%, maybe even 5%. Then we're talking about, yeah, gigantic dividends. Verizon, another stock I really like, telecom leader. It's not getting hammered too much. It's down 4% in the past week, but year to date, it's actually positive. However, the interesting thing about Verizon is that it's negative over the past 10 years. So it has actually fallen quite a lot. We just want this dip to continue here. And I mean, we look at some of these more kind of recent lows. This was in 2023, but we get this down to like the low 30s. That would be very attractive. And I mean, look, you look at the past 10 years, when it got down there, it bounced right back up. Like this is definitely a level of support right here. So if it keeps falling like that, man, we got to scoop up so many shares if it keeps falling. But already it's going to be very attractive. You're talking about a dividend yield of over 6%. So already very attractive. So I'll be buying more Verizon for sure. Pfizer, another stock that I've been buying. I'm going to continue buying. It's down 8% this past week. Look at a 10-year chart. It's negative in the past 10 years. This is a world leader in pharmaceuticals. Obviously a very controversial stock these days, for pandemic reasons and all that. But it's down huge from the pandemic. And it's basically at a decade low. So it's already at a decade low. And the more it falls, I mean, just the cheaper it gets. So yeah, already a stock to be keeping a close eye on. Let me see if I can click on the dividend. I'm having a hard time clicking on this, but here we go. It's set over 7% of a dividend yield on Pfizer. So already very attractive too. Okay, next up here, Stanley Black and Decker. Okay, so this one is going to definitely be hit by tariffs. As you can see, it's down 20% in the past week. It's going to be hit by tariffs because they make and sell tools. They're like one of the biggest in tools. So that's just like such a obvious thing to put tariffs on those kind of products and those materials and all that kind of stuff. But it's down 20% in the past week. And not just that, but it's negative in the past decade too. In fact, it's at like the lowest level of the entire past decade. It's even lower than the pandemic crash. So it is extremely attractive already. But if this fall here continues, I mean, we're talking about Stanley Black and Decker was actually a stock that I always wanted to own. Sorry, let me just close some of these tabs here so I can get into the dividend. But it was a stock that I always wanted to own. And now I finally started buying it myself, because we're at over a 5% yield. I just think that's super attractive. And if it gets up to like a 6% yield, yeah, that's even more attractive. So I really like Stanley Black & Decker. I just think it's going to be hit very hard by tariffs. Same thing goes for Scotts Miracle-Gro, although they are a leader. Again, we're keeping the trend going. I like leaders. They're a leader in home and garden products, but I should say garden and lawn care. But they are getting hammered here, down 10% the past week. And if we zoom out a bit, let's see, 3 months, it's down about a quarter of its value. And if we zoom out to the past 10 years, again, another one that is negative in the past 10 years. And we see how high it was during the pandemic when a lot of people were spending more time at home and doing lawn care stuff. So it was skyrocketing. This was a soaring stock. Now it's down to the 50s. If we get down, let's see, if we get down to like the 40s, I think 40s would be extremely attractive. So, and it's already very attractive, guys. I mean, we'll take a look at the dividend here. Let's see, where are we at for Scotts? Scotts, we're at over a 5% dividend yield right now. So already very, very attractive of a dividend. Okay, next up, Tyson Foods, leader in meat and poultry, down 4% this past week. It's a stock that can be pretty cyclical, but anytime we see it around this range here, it looks like a pretty good buy to me. And if it continues falling, we're probably talking about one of the most attractive prices that we've ever seen. Like if it goes down to the 40s, that's probably one of the most attractive prices we'll ever see. So Tyson Foods, another one, dividend yield over 3%. If that dividend goes up to 4%, maybe even 5%, I mean, that's a mouth-watering for a Tyson Foods type of stock. Now, these ones, I don't own these. Or I'm sorry, I do own that. I own Broadcom. These last two I do not own. But Broadcom first. I do own Broadcom. I've been kind of waiting for a dip in Broadcom. They're finally falling out. But yeah, they will be hit by tariffs. But they're down 16% this past week. In the past 3 months, they're down almost 40%. And then you look at this dip here. This is where it's falling here. It's skyrocketed recently. So it's still not a stock that I consider to be cheap. I don't consider it like an amazing, great buy here. If we didn't have the current situation in the economy with tariffs and everything, I would think, yeah, this is definitely a buy. But in the current situation, I think this needs to go lower. I think it needs to go quite a bit lower. So these last 3 stocks here, I just wanted to show you them because I'm kind of waiting for these ones to fall a lot more. But they're ones that I really am keeping a close eye on because I do really like their business. Snap-on is another one I've always wanted to own. I don't own this one. I've always wanted to. It's down 5% in the past week. When we look at like a 10-year chart, it's always such a good performer. It's hard to get this one on a dip, but it's finally dipping now a little bit. I really hope this continues. And then Air Products and Chemicals, I've always wanted this one too. It's actually down 15% in the past month, 10% in the past week. We look at it here, it's finally dipping here. Air Products and Chemicals, this is starting to get attractive to me. If we get it down to the 230s, if we get down to like the 230s, yeah, I would say 230s, I'm adding it to my portfolio. Yeah, 230s, I'm adding it to my portfolio. And if it goes even lower than that, I'll just keep buying it. I'll just kind of keep buying it all the way down. This is a stock that I think is really good too. When we look at their dividends, what do we got here? So Broadcom, 1.5%. Broadcom is not really a great dividend stock, to be honest, but it's just more so for other reasons that I own it. Scotts, we already covered. Sorry, I got to close some of these tabs. Snap-on, it's got a 2.6% dividend, not very high. And Air Products and Chemicals, 2.6, not very high. I want that to get up to over 3% at least. If we get it over 4%, then that starts to become a lot more attractive too. But yeah, guys, those are just kind of my quick thoughts here. Those are the stocks that I'm keeping a very close eye on, highest up on my watch list. Again, I will be buying other stocks too, but if you're asking me where's the majority of your money going, it's going to be in these stocks that I've covered in today's video, and especially, you know, some of the safer ones, Amazon, Google, stocks that just normally don't come down like this unless you have something dragging them down. I think it's going to be a great buying opportunity, guys. I'd love to hear what you all think down below. Trying to stay optimistic. I hope you are too. I'll be keeping you guys, of course, updated all the way through. So at least you're not alone in all of this. We're not alone. I'm not alone. I got you. You got me. And we'll keep having some fun videos and looking at stocks and looking for the best deals, always hunting for the best deals. But thanks again for stopping by, my friends. Thank you for all of your support. I really hope you're all doing well out there. I hope you're staying strong out there. Stay strong. It's going to be an extremely volatile, difficult year. So be strong out there. And yeah, leave your thoughts and comments down below. If you need anything, let me know. But yeah, I think that'll just about do it. I'll catch you guys in the next video. All right. Okay. Take care, my friends. Bye-bye.